What if the biggest mistake investors make is believing that markets are always rational? What if prices don't simply reflect reality, but actually change reality? This is the central idea behind George Soros's fascinating and controversial book, The Alchemy of Finance. Today we'll break down 7 powerful lessons from the Alchemy of Finance that can change the way you think about investing, decision-making, and uncertainty. This is WisdomLab. Let's begin. 1. Markets are not always rational. Traditional economic theory often assumes that investors make rational decisions based on available information. Soros challenges this assumption. According to his thinking, investors don't always see reality objectively. Instead, they interpret reality through their beliefs, expectations, emotions, and biases. Imagine investors believe a company is going to grow rapidly. They buy its stock. The stock price rises. The rising price attracts even more investors. More investment gives the company more resources and confidence. The company's actual situation may then improve because of the market's original belief. In other words, beliefs can influence markets, and markets can reinforce beliefs. This is one of Soros's most important ideas. 2. The theory of reflexivity. Now we reach the heart of Soros's philosophy. Reflexivity. The basic idea is that there is a two-way relationship between perception and reality. Investors form expectations about the world. Those expectations influence their actions. Their actions affect market prices, and changing prices can influence the real world. Then the new reality changes investors' expectations again. It's a feedback loop. Think about a housing boom. People believe house prices will keep rising. They buy more houses. Demand increases. Prices rise. Banks become more willing to lend. More people borrow money. More people buy houses. Prices rise even further. Eventually, everyone believes the boom will continue. But when confidence changes, the same feedback mechanism can work in reverse. Prices fall. Fear increases. People sell. Lending tightens. Demand falls. Prices fall further. The lesson? Markets don't merely reflect reality. Sometimes they help create it. 3. Accept that you can be wrong. One of Soros's most powerful habits was accepting that his own thinking could be wrong. That's surprisingly difficult. Most people look for information that confirms what they already believe. Soros approached investing differently. He constantly questioned his assumptions. Instead of asking, "How can I prove I'm right?" ask, "What would prove me wrong?" This mindset is extremely valuable. Suppose you buy a stock because you believe its business will grow. Don't just search for reasons to keep holding it. Ask, what assumptions am I making? What evidence would invalidate my thesis? What has changed since I bought it? If the original reasoning is no longer valid, changing your mind isn't failure. It's discipline. 4. Uncertainty is not your enemy. Many investors want certainty before making a decision, but financial markets rarely provide certainty. There are always unknown variables. Interest rates can change. Governments can change policies. Companies can surprise investors. Consumer behavior can shift. Geopolitical events can disrupt markets. Soros's philosophy suggests that uncertainty shouldn't automatically prevent action. Instead, investors should recognize uncertainty and manage their exposure accordingly. This means you don't need to predict the future perfectly. You need to understand the possible outcomes and protect yourself when you're wrong. A good investor isn't someone who predicts everything correctly. It's someone who can survive being wrong. 5. Recognize booms and busts. Soros believed that financial markets can develop self-reinforcing trends. A small change can become a major movement. Optimism creates buying. Buying pushes prices higher. Higher prices create more optimism. Eventually, expectations become detached from reality. This creates a bubble. But bubbles don't continue forever. At some point, investors begin questioning the story. Confidence weakens. The feedback loop reverses. And what looked like unstoppable growth can become a rapid decline. The practical lesson is not simply predict the next crash. That's extremely difficult. Instead, watch for situations where prices, expectations, and reality are moving further and further apart. When the story becomes more important than the underlying facts, caution may be justified. 6. Risk management comes before being right. Here's a lesson every investor should remember. Being right isn't enough. You also need to manage risk. Imagine you make 10 investments. You are correct about 9 of them. But the 10th investment loses almost everything you have. Your overall result could still be disastrous. That's why position sizing, diversification, liquidity, and knowing when to exit matter. Soros famously focused heavily on risk. The goal isn't to eliminate uncertainty. That's impossible. The goal is to make sure that a wrong decision doesn't destroy your ability to make the next decision. Think of investing like a game of survival. Stay in the game long enough, and opportunities will continue to appear. 7. Investing is also a psychological game. Our final lesson may be the most important. Markets are ultimately influenced by people, and people are emotional. They experience fear, greed, hope, panic, overconfidence, regret. These emotions can create opportunities, but they can also destroy investors. When everyone is optimistic, investors may underestimate risk. When everyone is terrified, investors may underestimate opportunity. The challenge is maintaining an independent mind. Don't automatically follow the crowd, but don't automatically oppose the crowd either. Instead, ask, what is everyone believing, and what happens if that belief changes? That question can reveal opportunities that ordinary analysis misses. If you found these lessons valuable, subscribe to WisdomLab for more powerful ideas from the world's best books.